So, good afternoon and welcome to today's Equity Release webinar. I'm Vicky McDade and I'm an Equity Release trainer for the Equity Release Network. The Equity Release Network are specialists in the UK, and as we only advise on equity release, this allows us to be experts in our field. Over the next 30 to 40 minutes, we'll be updating you on the current equity release market and reminding you who in your client bank may have a need for this product. Financial planning for retirement has seen many significant changes recently, making it more important than ever that those approaching and in retirement consider all of their financial options. Equity release and retirement mortgages have an important role to play. However, they are often misunderstood or overlooked. Our aim is to explain clearly the products now on offer, as there have been many recent innovations, who these products may be of use to, and how your clients can access the best advice even if you aren't qualified to advise on these products. In fact, by leveraging our expert knowledge and preferential rates, your clients will receive the best advice and could save money in the long run. At the end, we'll open the floor up to questions, which you can submit via the question function in your dashboard. You've been invited to join us today as an Intrinsic or Positive Solutions member. Last year, the Equity Release Network became an accredited referral service for you and your clients who may benefit from exploring how equity release can form part of their retirement financial planning. As mentioned, as of last year, the Equity Release Network are an accredited equity release partner of Intrinsic and Positive Solutions. This accredited partnership was formed for two reasons. Firstly, Intrinsic recognised the growing role equity release has come to play in financial planning for retirement. With more than £1.4 billion being released each year, this sector shows no signs of slowing down. Secondly, Intrinsic recognised the Equity Release Network's unique approach to equity release. Our unique approach is summarised here with a quote from our Managing Director, Steve Wilkie. We have designed our business model around the weaknesses in the market, kept our focus and continue to fix these weaknesses that we identified. The first issue we aim to overcome is one that concerns the regulator and the Equity Release Council, the issue of dabbling advisors, those that only occasionally write cases. It is difficult to keep up to date with the equity release market if you only write 1 or 2 cases a year. As dedicated specialists in this market, we keep up to date with new products and regulatory changes. We have excellent relationship management tools in place to assist us in keeping the customer informed. Our advisors have over 150 years of collective experience and keep the customer at the heart of everything that we do. The Equity Release Network also pride ourselves on working hard to spread the word about equity release. We've developed relationships with strong household brands so that our target market regularly see articles and information about equity release. To help you spot the opportunities, let's have a recap of the basics. Equity release is a product which allows older homeowners to raise funds via a mortgage that does not require monthly payments to be made. The interest rate is fixed at outset for the life of the loan. There are now hybrid mortgages available that differ slightly, and I'll give you more details on those shortly. Typically, instead of payments being made to the mortgage provider, the interest rolls up and is repaid with the original capital released at the end of the customer's lifetime, or when the property is sold if they move into residential care. The customer retains 100% ownership of the property, so they do not need to worry about being evicted. The products and advice are regulated by the Financial Conduct Authority, which should provide customers with peace of mind. And additionally, the Equity Release Council ensures that products adhere to a code of conduct which provide extra guarantees, such as a no negative equity guarantee which means that the value of the loan will never be higher than the value of the property. So no debt would ever be placed on the estate. This means that more clients are happy to consider equity release because they know they cannot lose their home or be a financial worry to their beneficiaries. Let's have a look at some of the significant figures which will help to explain why equity release has been a growing market and will continue to grow in the coming years. There are 7.9 million eligible candidates. However, only around 20,000 plans are written each year. So the current market is only a fraction of the potential market. Many retirees are asset rich but cash poor. 45% of retirees have inadequate income, yet pensioners have £807 billion worth of housing wealth. Investing in their properties seems to have paid dividends though, as average property prices have doubled since 2000. The post-war baby boomer generation have begun retiring, and this proportion of the population is set to increase to 19 million by 2050. The equity release market has been growing over the last few years, and there's now more than 1.4 billion being released annually. But with so many more people eligible, this has the potential to be so much higher. Another factor which has the potential to greatly increase equity release lending is the interest-only mortgage time bomb. Research suggests that £116 billion of interest-only mortgages are due to mature over the next 8 years, many with no repayment vehicle or strategy in place. For some, switching to a capital repayment mortgage may be an option. However, due to recent income criteria changes as a result of the mortgage market review, they may only have a few years left to repay a large amount of capital, which means that the increase in payments may be unmanageable. Some may consider downsizing. However, having been in their home for many years, they may no longer want to do this. Equity release could be an option for those affected. The equity release providers have responded by creating new products, not all of which fit the typical equity release profile, but may allow these customers to access a solution which allows them to stay in their homes. So, who is eligible for equity release? Quite simply, the youngest person on the deeds must be aged 55 or over. They must be a UK resident. Their property must be worth at least £70,000, and they must be wanting to release an amount of at least £10,000. There have been many innovations in the marketplace over the last few years, which we'll cover soon, but there are providers that will also now consider second homes and unusual properties, which may only be a small part of the market. However, looking at what equity release is typically used for may help to explain in a bit more detail. Equity release can be used for any legal purpose. There's really no such thing as a typical client. Many financial advisors consider that equity release is a last resort product or only used by those who have not planned adequately for their retirement. This simply is not the case. Recent research shows that a significant percentage of the funds released are being used by the financially astute. Equity release is increasingly being used as part of financial planning in retirement rather than as a fallback option. Home improvements do remain the largest factor for releasing funds. There has also been an increase in lending though to repay outstanding mortgages or to help other family members. It can also be used for house purchases, upsizing or second homes. This point is very important as it's often overlooked. Equity release plans can be used for a purchase, so for example, let's say you have a couple who live in a £180,000 house but want to move to a £200,000 bungalow, but they can't raise the extra £20,000. By taking equity release on the bungalow, this allows them to raise the £20,000 needed to complete the purchase. And that means they can live in the house that they choose rather than the one they have to settle for. Some people may worry that by using equity release they are reducing the amount of potential inheritance that may be left, But by using funds to help family members with education or getting onto the housing ladder, they could be providing more financial help by helping them to secure better paid jobs or by building up equity in their own properties. They could be supplementing their own income or investing in property to provide a rental income. As specialists in the equity release market, we know the provider's criteria very well and we're able to help more people achieve their financial goals. We have received new insight from the 3 largest providers of equity release, covering applications written over the last 4 years. There are 59 different customer profiles in total, and the top 3 profiles account for 14% of all applications. And these reveal that equity release is being used by the financially astute. It's not just a low-end product for those that haven't planned properly. To help you identify these potential customers within your own client bank, it's worth taking a look at them in a bit more detail. 5.2% of all applications come from the segment described by the research as sophisticated stability. 58% of this group are in the age band 58 to 67, and their average property value is £363,449. They are some of the most affluent people in the UK, professionals and business owners in their late 50s to early 70s. Many are seasoned investors and they're not adverse to taking risk or exploring new investment opportunities. They want growth and income, and most importantly, to minimise tax. Financially astute, they are comfortable using loans and they are a very low credit risk. They work at the most senior levels as managers and directors and are twice as likely as the national average to be self-employed business owners. Typical occupations include accountancy and business management. And on top of their leisure activities include holidaying abroad, the theatre, wine appreciation and golf. This group may not be who you expect to be using equity release plans, but they are the segment that account for the highest percentage of all applications. The next segment in terms of percentage of application are those termed middle-age spread. While the typical age in this segment is lower, 19% do fall into the age band 56 to 67, therefore fitting the age criteria for equity release. Which might actually lead us to believe that these are the most likely candidates to be using equity release, as a high percentage of applications come from a smaller group. Their average incomes are above the UK national average, as are their property values. They are active, moderate investors. Pension-related investments are of high importance. ISAs and protection also rank highly in their portfolios. They tend to work as managers and in clerical work in both the public and private sector, and an above-average number are self-employed. These are the most likely group to be carrying a mortgage on their property. Can you recognise this group within your own client bank? The careful experience segment belongs in the retired wealth category. These are affluent, largely retired professionals in their late 60s and 70s who have prepared for their retirement through wise investments. Many now own their home outright, and with no mortgage to pay, they're able to invest their money in a wide range of financial products. They invest in unit trusts, ISAs, onshore and offshore bonds, and a significant number have already purchased an annuity. They are concerned with maximising their pension pots and maintaining their standard of living as they come towards the end of their working lives. A substantial number of people in this segment are retired, although some still work at the managerial and director level. They live in substantial, high-value detached properties. As you can see, this financially sophisticated group account for a significant percentage of equity release applications, although they might not be the type of client you had expected. The reason we've outlined these client types for you is to show you that you could be missing an opportunity if you prejudge who may be interested in equity release. With the products being used for such a wide range of reasons, it makes sense to make all of your clients aware of the products available, particularly if they fit the profiles that we've outlined. But if they don't qualify yet, then they may well have other family members that do. Equity release providers are typically life companies, insurers or specialist lenders. There has been talk of some of the high street lenders entering the market over the coming months, and this again should boost the market. The more people that offer equity release and advertise its existence can only help to increase consumer awareness. As a specialist advice company, we have been able to negotiate specialist rates and deals on behalf of your customers. We have also been able to provide input when these companies are designing new products to help ensure that they create products that have the features that provide solutions to the problems that this generation of retirees are facing. A large proportion of today's retirees have health concerns, and many providers will now take these into account and may be willing to lend a higher proportion of the property value to those affected. Equity release plans covered by the Equity Release Council's guarantee have three basic formats. The lump sum roll-up mortgage, where all funds are taken as an initial release. Drawdown plans, where a proportion of the funds are taken at the start and further funds are available on reserve if needed in the future. And we'll also look at the new interest serviced options in a moment. The lump sum roll-up plan. Recent council figures have shown that around a third of plans written are lump sum plans, where all the funds are taken as an initial release. Drawdown plans where the average amount withdrawn is just under £75,000 and it's roughly a third of the property value. This sector of the market is on the increase and the average age of these customers is 68.8. Drawdown plans account for 2/3 of the market. This is where an initial sum is released but further funds are available in a reserve facility. Interest is only charged on the funds actually released. The average release is therefore slightly lower at £58,000, but they will be able to increase their borrowing in future years. These clients are typically a little bit older at 71.6 years, and the value released typically represents around 20% of the value of their properties. Some of these plans allow the client's state of health to be taken into consideration, and if they have health or lifestyle factors which affect their longevity, they may be able to release a higher initial amount. There are also plans available that will allow a proportion of the property to be ring-fenced so as to provide an inheritance guarantee. Recent innovations have seen the launch of products where the interest can be repaid on a monthly basis. The amount of interest being serviced is a customer choice. This allows the customer to protect more of their property for a future inheritance. It may even be that the beneficiaries want to contribute to this monthly payment to preserve their future wealth. The customer's income will need to be assessed and will need to fit the lender's criteria, but usually it will need to be retirement income that's payable for life. The income assessment is the responsibility of the lender. There's also an option to convert the loan to a roll-up plan if the customers decide to stop servicing the interest, and that may happen automatically if a number of payments are missed. Plans are also available where overpayments of the capital can be made. If this option is available, it's typically capped at 10% of the capital balance each year. These loans still fit the criteria laid down by the Equity Release Council guidelines. More recently, we have seen the introduction of retirement mortgages, which do not necessarily comply with all of the Equity Release Council guidelines. Essentially, the right to remain in your home for the rest of your life and to offer a fixed interest rate for life. Customers are required to pay the interest monthly, and if payments are not made, then their home could be repossessed. There is an option to change the plan to a roll-up mortgage once the youngest borrower reaches age 80 or after 5 years from taking the plan. The interest rate is also not fixed for life, The initial term of 5 years, and after which the customers have the option to fix for another 5 years at the prevailing rate or to remain on a standard variable rate. This gives the customer flexibility to benefit from future interest rate changes. Rates have changed recently and these plans may be available from as little as 4.5%. The amount that can be borrowed is based on what is affordable considering the customer's qualifying income. This type of plan offers a high amount for younger customers, up to 50% for those up to age 70, 45% for those aged 71 to 75, and up to 40% of the property value if they're aged over 76. These new types of mortgages are proving popular as they bridge the gap between traditional mortgages and equity release lifetime mortgages. They are useful to those that have the income to make payments and who want flexibility to make overpayments and possibly benefit from future interest rate changes. Importantly, they do offer some of the features directed by the Equity Release Council, particularly the no negative equity guarantee. So the customer would never owe more than the value of their home, which provides them with peace of mind. This slide shows which providers offer which types of plan. Historically, the largest providers of equity release have been Aviva, Just Retirement and Liverpool Victoria, although we are starting to see changes in the marketplace. New providers have been quick to offer interest-only plans, while others are still developing products. Not all providers take medical and health information into account, and as the market shifts, more providers are making their products more flexible to fit in with the needs of today's retirees. There has been talk of new providers entering the equity release arena, potentially some of the high street banks. So we're sure that there will be more innovation and competition in the near future, which ultimately benefits the customers. Our advice process is designed to ensure that all customers receive high quality advice from very experienced advisors. We only write equity release plans and as such are considered experts in our field. Typically, our advice is given face-to-face with 2 home visits to ensure that the clients have the opportunity to understand the products thoroughly and ask any questions. We also encourage other family members to attend, and we're happy for you, the introducing advisor, to attend as well, which may help to increase your knowledge of the products and the specific advice process. We also ensure that any recommendations are reviewed and signed off by 2 advisors. Our advice is given without obligation and we only charge an advice fee when a customer proceeds to take out a plan. This should give you peace of mind to refer any clients who express an interest, as they can investigate their options and they're not charged if we cannot resolve their issues with an equity release plan or retirement mortgage. Now that I've shown you how you and your clients can benefit from a referral to us for advice, you might be thinking, who can I refer? If you start by reviewing your existing clients, those clients that undertake regular reviews with you, do you tell them about equity release? Those approaching retirement should be aware that such products are available. Even if they don't need them now, it would make sense for them to know that if their circumstances change in the future, this option is available to them. It may also be useful for them to know that these products can help them to help other family members if their circumstances change. For those clients that do not undertake regular reviews with you, you could consider sending a newsletter to your client bank highlighting who can use equity release and what it can be used for. You might want to organise a client seminar providing information on equity release and other retirement products. You might want to email clients to let them know how to supplement their income in retirement. Referrals are a very effective way of generating leads. Do you ask for referrals at every client meeting? Do they have friends and family that could also benefit from expert, no obligation advice to explore the options? Once you've seen how equity release can benefit your clients and how it can bring an extra income stream into your business, you might want to look at generating leads from new clients. The Equity Release Network are happy to help you do this by providing newsletters, advertising copy, flyers, even presentations for you to use at seminars or online. By attracting new clients who could have a need for equity release, whilst this could generate a lead to us, you will also benefit by helping them with their other financial planning needs. You might consider setting up networking groups or seeking out other professionals to work with, for example solicitors, estate agents or providers of long-term care services. Many referrals actually come from younger family members, so it might be worth considering advertising online. That could take the form of a website, blogging, podcasting or even your own webinars. All of these can be effective for contacting new clients, and if you would like us to help you with the campaign, then please do get in touch. By referring your clients to us, you're ensuring that they receive expert advice which can save you time while still allowing you to earn for any cases written. If you're not qualified to equity release business, then this can be an extra income stream without the need for you to take extra exams. The majority of advisors who are qualified still only write a few cases a year. This means that you need to keep up to date with product innovations, new lenders coming to market, changing criteria, all for just a few cases a year. As specialists, we focus solely on this market, and therefore it's easier to keep up to date with changes because we only write equity release business. We're not distracted by other products. This also allows us to negotiate specialist terms with the lenders. This means that your clients will benefit from lower interest rates and you will receive a share of a higher commission amount. And we also have access to dedicated case handlers with lenders and solicitors to ensure that any cases complete smoothly. I'd like to demonstrate these rates with a few examples. As specialists, we can negotiate better interest rates for your customers, which can mean a significant saving over time. Just as important is our knowledge of lenders' criteria and helping customers to shape their cases to ensure that their needs are met in the most cost-effective way. Let's consider a couple aged 60 with a property value of £220,000. The fact find reveals that the clients would like £40,000. If you source this amount from Aviva, the rate applied would be 5.77%, although they have dropped recently, but this example was corrected a few weeks ago. With our specialist knowledge and access to flexibility from Aviva, an equity release network advisor would suggest that if they reduce the amount being borrowed by just £400 to £39,600, then the interest rate applied would be significantly lower at 5.4%. Over 20 years, that represents a saving to your customer of £8,314. which is good news for the customers and for their beneficiaries. Our second example also shows how shaping the case can affect the interest rate and still ensures that the clients achieve their financial goals. Let's take a 70-year-old couple with a property value of £500,000. They would like to release a sum of £100,000 and have a reserve in place of £60,000. If an advisor sourced this loan as requested by the client, then a rate of 5.33% for the initial release would be generated. However, by using our fact find and probing further into the client's anticipated future needs, setting the reserve at a lower figure of £40,000 will still be sufficient for the client, but it would reduce the interest rate on the initial amount to 5.21%. Over 15 years, that represents a saving of £3,694. The benefits of introducing your clients to the Equity Release Network, as well as the expert advice, is that they can benefit from preferential rates from the lenders, but you will also receive a higher share of a higher amount of commission that we've negotiated with the lenders. In this example, a customer wanting to release £50,000. If you introduced your customers to an advisor who only writes a few cases a year, they will have to accept the lender's standard terms. Typically, you may receive a 50% share of the commission, but that will also be on the standard commission terms. In this example, half of £750, so £375 to you for your introduction. If you introduce to an advisor who is a member of an equity release mortgage club, you may have access to better terms, and you could receive half of a higher commission amount, potentially giving you £500 for your introduction. However, by introducing your clients to the equity release network, you'll receive a higher amount. We will pay a 60% split for intrinsic and positive solutions referrals. So in this example, that would provide you with £1,005 for your introduction, more than was actually paid to the first two advisors for writing the case themselves. So I hope that I've shown you why the equity release market has been growing and why it will continue to grow over the next year and decade. You can generate an extra income stream to your business and provide the best service to your clients by introducing them to the equity release network. This slide summarises the points that I've covered. We guarantee not to cross-sell to your clients, so you retain the relationship. You will receive a generous split of our enhanced commission terms. And by referring your clients to us, you don't need extra exams, professional indemnity, and the time you save by referring these clients can then be spent on your other areas in your business. We offer expert, independent, unbiased advice, allowing your customer to access all of the products available if appropriate. We have negotiated specialist terms with the lenders and specialist solicitors which will save your clients money now and over the life of the loan taken. Your clients can choose face-to-face or telephone advice, and you and their family are welcome to attend. Your clients will benefit from expert, experienced advisors, and we have sophisticated support systems and teams to ensure that we provide the best possible service to you and to your clients. Referring your customers to the Equity Release Network couldn't be easier. Our website, www.equityrelease.pro/intrinsic, allows you to enter your client details, which is simply their age, property value, whether or not there's an outstanding mortgage, and their client and their contact details, so that we can get in touch with them promptly to arrange a meeting to discuss their needs. You can also call us free on 0808 115 5833. We're happy to answer your questions to see if Equity Release can help your clients with their financial planning. This is also the website that you need to register on, and that's just your first name, last name and email address. And as soon as you register on the site, you'll be given access to the marketing tools that will help you to generate referrals from either your existing clients or from new clients. I'd like to thank you for joining us today, and I hope that I have shown you how referring clients to the Equity Release Network can help your business and your clients. Next time we'll look in a bit more detail about specific client types. I mentioned there's no typical client, and we'll be looking specifically at those that can use Equity Release to help them plan for their retirement. With new products coming to market, those struggling to pay off a mortgage before their retirement may be able to access a solution that fits their budget. And of course, more and more people want to help their family members and provide an early inheritance when they need it, rather than when the inevitable happens. I'm more than happy now to open the floor up to your questions. Before I get a flood of questions asking for copies of the slides, we will of course provide details of those to you. There should actually be a recording of the website being put on the Intrinsic website, so if you need to go back and have a look at that. And after this presentation, you will be emailed a copy of the slides. I know we had a few technical issues during there where we lost sound for a little bit and the issues at the beginning. So thank you very much for waiting and bearing with us. So let's have a look at some of the questions coming through. Let's have a look there. We've got a question coming through, highlighted comparisons with regard to enhanced commission. How do the fees to the clients compare? They are, with the market, they're fairly sort of typical of the other specialists in the market. I think the important thing to mention there, as I hopefully highlighted, is that actually we only charge that when they actually go through, and that can be perhaps added into the loan as part of that. So obviously if there are specific questions with regard to individual cases, what we'll do is we'll get somebody from our office team to give you a call and highlight those. But the important thing there is obviously they can investigate all of their options, and if they choose that equity release isn't the solution for them at this time, they're not actually charged for going through that advice process. And the fee actually doesn't relate to the amount of commission. The commission is purely based on the volume that we provide through to the providers. As you mentioned, we've got more than 20-25 advisors writing a good number of cases every week. So compared to the average advisor that, as I mentioned, only writes 1 or 2 cases a year, because of the pure volume of cases that we're able to provide through to the lenders, that's why we're able to negotiate a higher amount of commission. That doesn't impact on the fee payable. Another question, I hope I've answered that clearly. Another question that's coming back through is, would any adverse credit have a similar effect to mortgages? With regard to equity release, it doesn't usually, no. I highlighted some of the customers there that are typically a lower credit risk, because with the traditional equity release, the roll-up mortgages where interest payments aren't being made, the loan is just repaid with the interest rolled up at the end of the presentation. So actually a client's credit rating doesn't actually have any effect on that in the same way that normal mortgages, it would perhaps affect the credit score. That doesn't happen with equity release. Having said that, I have known cases previously where clients didn't disclose any adverse credit, and that had issues when we came through to application because it came under the heading of non-disclosure. So I'm aware that some of the providers, are more than happy if customers do have credit there, and I'm aware of cases that have gone through, even with CCJs, potentially up to sort of 5 or 10,000. That hasn't affected the mortgage going through, but what you do need to be very important about is that we tell the lenders that that's what's happening. Typically, in that scenario, the money being released would be being used to repay any adverse credit. So, of course, we're all grown-ups. We accept that, yes, they've got adverse credit. That's the reason they're taking the loan, and they're going to repay that and not get themselves into that situation again. So as long as the providers are aware, then we won't have any issues getting that mortgage through. Okay, another question has come through there and said, are you happy to look at remortgage cases from clients with existing equity release mortgages to see if they can get a better deal? That's a fantastic question. Thank you for that one. Yes, there are a couple of caveats, which I'll come back to, but typically, if you're keeping an eye on the equity release over the last couple of weeks, there does appear to have been a kind of sort of rate war, if you like, which is very good for the customers. We've seen rates drop, by 0.5%, 1% typically. So, yeah, if you've got clients that took out equity release a number of years ago, maybe at those higher interest rates at 6 or 7%, yes, we've got 5% deals available now, so that could be a significant saving to them on the potential amount of interest that will roll up over years. What you do need to be careful with in those cases is whether or not their existing lender has any issues with early repayment charges. Potentially some of those, I know the old Northern Rock mortgages where you've had a company which has stopped providing mortgages. Sometimes in those cases, the provider will waive any early repayment charges because they're not able to do any more lending, so the clients may well be free to take that away and to have a look at a new equity release plan. Some of the other providers have a sliding scale of early repayment charges. So some of the providers have 5% in the first year, 5, 4, 3, 2, 1, and after 6 years, after year 5 or 6, they're free to take that away with no penalty. So again, if they've taken that away, there may be a small amount payable depending on how long since they took it. So you'd have to balance the saving against any potential charges. And a couple of the other providers have a rather complicated, being polite, calculation, which typically the Aviva plans are linked to a specific gilt, and the Just Retirement plans are linked to the 15-year gilt index. So depending on what's happened with those particular individual gilts or the 15-year gilt index, there may be a calculation that if interest rates, that if those gilt rates have changed, there could potentially be an early repayment charge to pay. But some of them typically have caveats. So particularly with the Just Retirement plan, if the rates have changed by 0.2%, gone up by 0.2%, then the calculation actually always comes out at a zero amount. So more than happy to look at those, and definitely it would be worth having a look, reviewing those old cases, and we can obviously have a look, see if there's early repayment charges that need to be paid, and how does that balance out against, if they're going to have, still be around for another 10, 15 years, if they can get a plan that's 1 or 2% cheaper, is it worth moving across? So definitely those are worth looking at. Another specific question there, what percentage of the property could be released for 63, 65-year-olds? It really depends from provider to provider at the moment. Some of the plans might sort of start at age 60, that you might be able to release something like 20, 25% of the property value. Having said that, Aviva have a kind of sort of flexibility tool now, so you have to input all of the client's details, and that produces a bespoke amount of loan. So while some providers are very clear, they have a specific amount that's available at a certain age, some of them will take into consideration other factors. So again, those that provide a different amount for those that have got health concerns, and that may just be that somebody's a smoker or overweight, or if they're diabetic, if they have concerns that are going to affect their longevity, some of the providers will actually allow those people to take a higher proportion of the property value. And I think recently Aviva changed it so that you could either have an increased amount of loan available, or it might actually have the effect of reducing the interest rate. So some providers, it's very clear cut what amount you could be looking at, and I think that 63 to 65 range, you're probably looking at about 25%, but because of all the flexibility, it's not clear cut. So it's definitely worth having a look, and it'd be very quick for us to find out, take some basic customer details and give you an exact figure of what's available. Another question's come through there. Do clients and their families need independent legal advice? Yes, definitely. That's part of the Equity Release Council guidelines, actually part of the Code of Conduct that all of the providers sign up to. They do need to have a solicitor involved to provide that independent legal advice. And again, it comes back to a question of specialists, really. As we've mentioned, we deal with equity release all the time, so we're very aware of how the cases work, what issues to be accounted for. That applies to solicitors as well. There are specialist equity release solicitors, typically, sort of companies such as Equilor and Ashford. They're very used to dealing with equity release cases, so you don't have issues. Sometimes you might have a case where, there's a family solicitor, he or she personally doesn't like equity release, or they had a bad experience with equity release cases 10, 15 years ago. And sometimes that can actually cause a bit of a problem if you have a solicitor that doesn't understand how equity release has changed. So yes, they do definitely need to have independent legal advice. And again, as there are specialist advisors, there are specialist solicitors that it would be helpful for the clients and their families to talk to. There was another question with regards to fees and commission. In terms of the fees and the commission, obviously we will come back to you individually to discuss business terms. Any advice fee that's charged, that would actually stay with Equity Release Network, and it's the split of the commission that we share through with Intrinsic and Positive Solutions members. So I hope that's partially answered that, but we will obviously look to follow up with you individually to discuss the business terms. We've got details on screen of our partnership development expert, Tom Brett. So his telephone number's on there, and if you call through to that number in the team, the people answering the phones, actually, they all do have experience of equity release and a good level of knowledge. So, you're not just calling through to an answer service in a call centre. The people answering those phones do have knowledge of the cases. So if there are specific details, you'll obviously be able to get good advice and assistance from them if you call through. Let's have a look. There's another question coming through with regards to unusual properties. I mentioned that some providers now will allow second homes to be, it might be that you're raising money for a buy-to-let property if somebody wants to do that. The equity release mortgage does need to be paid, it does need to be taken on the residential property, but as a reason for taking funds, that they're going to use that money as a deposit to allow them to get a buy-to-let property and perhaps take a buy-to-let mortgage on that amount. Certainly that can be done. A couple of years ago, the providers were a bit more flexible on the types of properties that were available, and they do seem to have tightened their criteria over the last sort of 12, 18 months. Having said that, they're potentially looking to be more flexible again. So there are lots of different things. Some companies, might have a different policy for a property with a flat roof or a thatched roof, whether there's an element of commercial, particularly if there's an amount of land attached to the property. The providers have very differing criteria. However, what we do have available to our advisors is a matrix which clearly shows us which providers are able to assist with which types of property. So if you've got an inquiry, again, the advice would be not to prejudge whether or not you're going to be able to place that as an equity release case. Just give us a call. If it's an outright no, we'll be able to tell you. If we know that some lenders consider it, whereas others don't, again, that's why we're there to help you as experts. There's a case there where the commission is paid via intrinsic mortgage. Not 100% sure on that. I will get Tom to come through and discuss that with you, because I'm not sure exactly how the payments work and whether intrinsic take any details of that. So again, that's not answering the question, but we'll come back and answer that directly with you. In terms of, there are properties abroad at the moment, that's not available, and there are actually even certain pockets of the UK where some providers don't lend. So, for example, you might find it difficult to get mortgages in the Isle of Man, Northern Ireland, or even some parts of the Scottish Highlands. Some providers would have issue with that, but other providers are happy to look at those. So, again, if you've got a property in an unusual area, it's worth just double checking with us if those are available. There's a question coming through with regard to the affordability checks on the interest serviced options. I mentioned in the presentation that the amount of interest being paid is a customer choice. With the retirement mortgage that I specifically mentioned, which is available from Hodge, they do need to be servicing 100% of that income. the interest, and the affordability of the customer and their ability to pay that income will be checked by the lender. So if they're able to pay 100% of that, that's fine. Some of them are available on a part and part, so it might be that the customers say that they want to service 100% of the interest. Let's just, for example, say that figure's £300 a month. If once the provider has done the affordability check, they believe that the client can only manage £200 a month, then £200 a month will be the amount that's serviced on a monthly basis, and the extra £100 would then be set on a roll-up basis. So you actually get a part and part. So part of it, the interest is being serviced, and part of it is on a roll-up mortgage. So again, that fits with the affordability of any customers. If they can't afford any payments, then the traditional roll-up mortgage will be what's used for them. If they're able to pay some of the interest, again, then they're able to do that. And as I mentioned in the presentation, some of the providers will also allow for overpayments now. So if a customer thought that they could pay that extra £100 a month, the provider doesn't agree, what they could always do is save that amount separately in account, and then perhaps once a year, if they've still got that £1,200 left, then they could make that as an overpayment to the lender. Additionally, if something happens in the property, I don't know, if the washing machine breaks or they need to do something with their car, or any sort of emergency or unexpected expenditure, again, at least they've got that extra £100 a month saved in an account if they need it. So as well as servicing interest, some of them do now have that flexibility to make overpayments. That also might work for some of those customers that are still, potentially working on a self-employed basis. They might get an annual bonus through from a company that they have a link to, so that might be useful to them to be able to make those overpayments of capital if needed. Let me see, final questions come through there. We'll close in a second, so if there are any further questions coming through, send them through now and we'll have a look at those. Otherwise, obviously, we're available afterwards. We mentioned the impaired, like I said, it could be something as simple as they take high blood pressure tablets, perhaps they're sort of smokers, things like that. Alcohol intake could be taken into consideration as well. Could be that they're diabetic, heart problems, anything really. Some of them have a sort of a simplified medical questionnaire, some of them have a more detailed one. But again, it's just really for the clients to be honest, and if they're actually looking for that maximum amount, then it might be that we're able to actually pay them a little, offer them a loan of an increased maximum, or as I mentioned with Aviva, some of their flexibility actually might look to reduce the rate. So again, with so many different plans available, with so many of the providers changing their criteria and being more flexible, it really is worth looking at equity release for your clients if they want to look at all of their options. Certainly with the changes in the market and how competitive it's getting lately, I think in terms of the market at the moment, perhaps now is one of the most interesting, exciting times from an advisor point of view. That really are looking after the customers and wanting to make their products more available to a higher number of people at the moment. So, okay, I think I've answered all of the questions come through, so hopefully that's okay. If I haven't managed to answer anything clearly, obviously take the email address or the telephone number and speak to us afterwards. We'll be able to give you a definite answer on those things. I haven't had any more questions coming through for a few moments, so I will sign off now, but as I say, thank you very much for joining us today and staying with us through our technical issues. We are looking to have a regular programme of webinar events, so what we're possibly looking at doing next time is going into a little bit more detail about that specific retirement mortgage, and maybe have a look at a few sort of case studies of people that have used that and the typical rates that we're able to get now. So just leaves me to say thank you very much for joining us, and we look forward to working with you in the future, and we hope to be in contact with you very soon. So thank you very much, and goodbye.